Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around the country on the Community Radio Network. I'm always pleased to welcome back to the microphone Natasha Panagis from the Institute of Financial Professionals Australia. Natasha, welcome back.
Hi, Ray. Thanks for having me back on the show.
Well, we have got so much to go through today, and this is not going to be just one show, ladies and gents. It's going to be a number of shows because, believe it or not, we're already getting ready for the end of the tax year. It's like, wow, where's this year gone? And Natasha and I caught up just recently at the National EOFY conference down in Melbourne. So we were able to actually catch up. There was a lot of good regulatory updates that Natasha and her panel of experts at EOFY were able to give to their members that were turned up on the day. And also, Natasha had quite a vibrant online turn up as well, didn't you?
Yeah, we did. I think we had over 200 people online and then probably the same amount in-house. So it was great to see everybody back in the house and, listening to our updates, which is great to see.
It certainly was. And again, ladies and gents, I had a chance there to be as a fund manager, but it's always really interesting being able to talk to a smattering of people across various disciplines. And today what we're going to do in a number of different shows, ladies and gents, we're going to cover off a end of tax year checklist of really good hints that Natasha and I are going to go through, or mainly Natasha. I'm the prod and Natasha's the expert, but I guess from that perspective, it covers a lot of small businesses, but it's also a very personal type of checklist. And then in a subsequent show, we're going to really focus in on Natasha's expertise around superannuation. And some of these, I've got to tell you, Natasha, I learned something that I wasn't quite au fait with, or, sometimes you get lost in your own little world. You think you know it all. And then you sat down, and I'm sitting there taking notes furiously because I thought, I don't know this stuff. So it was really, really useful. We're going to cover that in the next show. So we've got a ton of stuff to get through. So let's kick off. So the first thing that the tax checklist talks about is bad debts. What should people be looking at there?
Yeah, look, Ray, if you've got some bad debts and you know that they're just not going to be recoverable, then it might be worthwhile thinking about writing those off by 30 June of this year. So that's one of the first things to consider.
Mm-hmm. Okay, so director fees and employee bonuses. I guess there's been a lot of movement now around director fees and how they're classified. I know I see that in accounting software, and also the recently implemented director ID numbers. So what's happening there?
Yeah, that's what we're suggesting, is to consider confirming your commitments to pay those directors' fees, and any employee bonuses should be made before the 30th of June this year. In other words, those resolutions need to be put in place, and those employees will need to be notified as well. And of course, pay-as-you-go withholding will also need to be withheld when you're making those payments.
Right. And I guess it's that consideration. Director fees are considered income, just like anything else, aren't they?
That's right. That's exactly right.
Okay, good. Let's move on. Donations.
Yeah, look, donations. I mean, if you had plans to, donate, whatever that may have been, to whatever charitable cause, then it might be worthwhile bringing those forward into this financial year, and also having the highest earning member of the family pay for them, because they get the better or the bigger tax benefit. And do that before the 30th of June. And just keep in mind, if you do have donations, then they cannot create a tax loss position for you. And as always, make sure you keep those receipts just in case you're asked to confirm that you actually paid for them.
Yeah, it's one of those fascinating things. I guess I get hit up for donations all the time. And as a side conversation, I help my children, adult children, they're all in their 20s now. And so when I was doing my daughter's tax last year, I said, do you have any donations? Thinking that, no, probably not. Well, she had so many, it was doing my head in. And she does all these monthly things, and she contributes to Patreons and a whole range of different things that were all tax deductible. And so she showed me these, and she had records, and I went, my word, it was like, wow, she was quite generous, especially compared to tight rear end me, but it was just one of those things. But so when we put it down, and again, she said, look, I've got all the receipts for that. It was quite legitimate. And I guess there are people out there that do give across the board to many charities. So again, record keeping's big, isn't it?
Yeah, definitely got to keep those records, and also just check that, you know, with your donations, just make sure that that charity that you're donating to is a deductible gift recipient. So that's an important thing to think about, or to remember when you are, in order to be able to claim a tax deduction. So make sure it is a DGR, or a deductible gift recipient.
Good. We love TLAs on dollars and DMS, dollars and making sense. There we go. Now, interest.
Yes. So interest is also, you know, worthwhile considering. If you can prepay interest on any loans for any income producing assets by 30 June, then again, that could be something worthwhile to consider. Again, just have a chat to your accountant about whether that will be worthwhile for your situation. So yeah, so another tip to consider there.
Okay, so that's when you're paying interest. But if you're receiving interest, one of the things that's really interesting, and we talked about this at the conference, is that when people prepare their tax these days, particularly if they're doing it themselves, a lot of this information is already pre-filled. Now, Natasha, I know where it's coming from, but maybe you might want to inform the audience. Where does this information come from, so that when they all of a sudden bring up their tax return, all these all these numbers are already sitting there?
Yeah, that's right. There's a lot of pre-fill that goes on in your tax return. So there's a lot of data matching that the ATO has with a range of government agencies and organisations. So, you know, a lot of your shares, your dividends, any managed fund distributions, any type of income really that you receive from organisations or companies or that you invest in will be, I suppose, given to the ATO and will appear in your tax return. So it's one thing. I mean, that's good, because it does make the whole end of financial year process easier. Everything's already recorded, but it is important to check that that information is accurate. I know from personal experience, certain amounts of income and supposedly capital gains were pre-filled in my tax return, when simply I didn't sell those assets, and the ATO had thought that I'd sold them and made a capital gain. It was simply just a change of, some change, moving things off market, which triggered, you know, a change and, you know, a bit of a warning sign for the ATO to think that that was actually sold. So that's what I mean. Just make sure that everything that's in there is actually correct, and you know, just match that all up with what you actually received versus what's in your pre-fill for your tax return.
Now, I think it's worth mentioning as well. I'm a dinosaur. I'll admit it. I'm over 60 years old, and people look at me and go, you know, it's a wonder you can still sort of read a computer, Ray. But it's one of those funny things that I still reconcile my credit cards. Now, people look at me and go, why would you even bother? It's amazing how many transactions that all of a sudden turn up that my wife, for example, has had her data phished on a number of occasions through no fault of her own. And just like when you're doing your taxes and you're checking receipts, make sure that the ATO, for example, are correlating your interest, your earnings, everything that you're doing. Same thing for your credit cards as well, ladies and gents. It's a handy thing. Just don't take it for granted that what's on there is correct. And again, given the fact that, you know, credit cards can be easily hacked these days, it's amazing how many transactions end up little bits and pieces here and there. But my old man used to have a saying, without that 1 cent, 99 cents is not a dollar. And again, it all counts. It all counts. Anyway, let's keep moving on. We've talked about, I'll bring forward deductible expenditure. So that's sort of like the same thing with paying interest in advance, isn't it?
It is. So this is where you can, claim deductible prepaid expenditure where that expenditure is below $1,000, excluding GST, or where that expenditure is required by law. So, for example, you know, car registration fees. So where your expenditure is $1,000 or more, then small business entities can deduct the full amount of those prepaid expenditure if it relates to a period of 12 months or less. Now, just note that this is also available to non-business expenditure of individuals And they could be things such as work-related expenses or rental property expenses. So that's another tip to consider before 30 June.
Okay, so in the same, the prepaid deductible expenditure in the same way, the bring forward deductible. So they're kind of the same thing, really. You're looking at the pros and cons of that fine. Again, 30 June, 1 July is a line in the sand, but you've got to make sure some things fit on one side of the ledger compared to the other. Okay,
yeah, and of course, that's right. I just mentioned that. I mean, if you're planning on purchasing certain items anyway, then it might just be worthwhile bringing those purchases forward into this financial year to claim the tax deduction now, as opposed to from 1 July next year.
And again, there are many, I guess, point of sale and car manufacturers that know this. And so the big thing that will happen between now and the end of the tax year, being June 30, is you'll see a lot of companies that will be saying, hey, move now, act now, get your purchase in to be able to, take advantage of whatever deductions that you are availed of at that particular time. Okay, let's move on. Reviewing stock. Identify any unusable or obsolete items and then write them off. This is kind of similar to bad debts, would it be?
Yeah, so with bad debts, it's more about if you've got a receivable that isn't going to be paid, but you don't want to admit it, that's when you'd write off a bad debt. With obsolete stock, it's similar in that if you've got unusable or obsolete items, and they're not really going to be used at all, then it might be worthwhile writing that out of stock before 30 June and taking the deduction as obsolete stock. So again, it's just one of those things that if you've got things sitting around in the office or in the warehouse and you just know that they're not going to be used, then just, write it off and get tax deduction by 30 June this year.
Yeah, it's one of those terrible things that when I discuss with people and say, oh, it's a tax write-off, and I'm looking at them going, guys, yes, it is, but guess what? You've got to make revenue to be able to write the tax write-off against. And so when people talk about, and it's a throwaway line. I don't know if you've ever noticed, Natasha, people will say, oh, you can just write it off. And I'm just sitting there going, yeah, but you've got to make the money to be able to write it off against. And no different to when previous government announcements that have said, hey, we're giving you an extra write-off. Some people expect a check in the mail. It's like, no, that's not the way it works. And so you've got to make the money to be able to write it off against, don't you?
That's right. Look, the debt must be more than simply doubtful, and there are a whole range of requirements that do need to be met in order to, write off bad debts and things like that. So, it's just something to consider that if you do have things sitting on the floor and you know that they're just obsolete, or if you've got bad debts there that you're just not going to get paid back, then it might be worthwhile thinking about writing these things off before 30 June. But have a chat to your accountant to see if these tips will apply to your situation.
Absolutely. Well, look, we're just about halfway through the show. I'm here with Natasha Panagis from EOFY, the Institute of Financial Professionals Australia. We're going to take a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm Ray Treverson, and with me at the microphone is Natasha Panagis from the Institute of Financial Professionals Australia. We are talking tax, and we are talking about checklists today and what we need to be doing in preparation for the end of the financial year. Now, we are going to talk about depreciation now, and I think probably out of all the things that we talk about when you're looking at tax write-offs and the like, and we were talking about that just before we went to the break, I think depreciation is probably one of the most misunderstood things. What is depreciation, Natasha?
Yeah, look, with depreciation, depreciating assets that cost less than $20,000 and that have been acquired from 1 July 2023 can be eligible for an immediate deduction where that business has an annual turnover of less than 10 million. Now, those assets need to be used or installed ready for use by 30 June 2024. Now, this measure isn't law just yet, but it is expected to pass shortly. So, if you've got certain things that you would have purchased, such as a laptop or other tools or other equipment, or even a motor vehicle, this legislation that's expected to pass soon will set this small business threshold for claiming an outright deduction for the cost of depreciating assets to $20,000. Now, if you're planning to make these purchases in any case, then you would be better off with sorting that deduction out and making sure that it falls into this financial year where the tax rate is higher, because from 1 July next year, the stage 3 tax cuts are legislated and will go down. So everybody will get a tax cut from 1 July 2024. So that's why it might be worthwhile thinking to purchase these products in this financial year so that you get a higher tax deduction this financial year. So whether it's taking a visit to JB Hi-Fi, Bunnings, or your nearest car yard, it might be worthwhile doing that before 30 June, then from 1 July next year.
And one gets the feeling that the retailers will be very savvy to this and marketing appropriately. Okay, so one of the things we should mention as well, all of these scales and all of these checklists are available to members of the Institute. But again, we'd normally find this information will be readily available on the ATO website. But again, one of the really good things about contacting Natasha's membership is that these are seasoned professionals that are trained and obviously understand accounting laws and legislation. Certainly a lot better savvy on tax rules and the like than I am. And, that's what we need, certain tax advice at times. Okay, so let's keep moving on. Oh, this one I'm quite interested in, electric vehicles.
Yeah, look, here's another tip for electric vehicles. Whilst we're on the depreciation front, there is an electric vehicle fringe benefit tax exemption now available. So, just be mindful that where an employer does provide such a vehicle to an employee, depreciation deductions should also be available to the employer, subject to the car limit. So another tip just to consider for electric vehicles. We know that there is an incentive there to take them up, and such tax concessions are trying to certainly push that for people to get into.
And that goes hand in glove, ladies and gents, with a show we did last year on tradies vehicles. I did a show with Frank Drent from the Institute, and we were talking about tradie FBT rules and regulations, and there was a lot more to it than one thought. And man, that was one of the shows that we got so many hits and so many questions on because I think it asked more questions than it answered, which is kind of good. People came away from it going, oh, I need to go back and relook at that because certain assumptions were made. And again, when it comes to tax law, don't assume, find out, and let's keep going on. Okay, deferring income.
Yeah, Ray, look, that's another option. If possible, if you can defer income until after 30 June, that would be worthwhile for those small business operators. It might mean you send out your invoices a little later. There are a whole range of tax benefits for doing that. And you could be looking at things that could be quite worthwhile. So have a chat to your accountant about, what types of income you may be able to defer until next financial year.
Again, this next one's a bit of an interest one for as well, skills and training investment. And again, there's some bonus deductions here that I wasn't aware of. And given that there's a lot of training incentives out there today, this could be quite useful as well, couldn't it?
Yeah, definitely. So it's worthwhile taking advantage of the small business entity skills and trainings boost before it ends, because it does end on the 30th of June this year. Now, this boost enables small businesses to deduct an additional 20% of expenditure that is incurred for the provision of eligible external training courses to their employees by registered providers in Australia. So worthwhile, taking that up because it does expire very soon.
Okay. Again, this next one I wasn't aware of either, an energy incentive. So taking advantage of a new energy incentive. What's that all about?
Yeah, the energy incentive, this provides a bonus deduction of 20%, and eligible assets include things like heat pumps, electric heating or cooling systems, and demand management assets such as batteries and thermal energy storage. So
Wow.
there's some of the things that you can purchase. Eligible assets or upgrades do need to be first used or installed, ready for use by 30 June 2024. And again, this incentive is in the same bill that I was referring to before, which is currently before Parliament, and we are expecting it to pass before 30 June.
Okay. Now, similar to, I guess, write-offs of stock and bad debts, the next point here is to crystallize capital losses. Man, I know about this one. Be mindful of the wash sales prohibition. What's that all about?
Yeah, look, if you've got assets that that are not doing well, and you may have made a particular capital gain this financial year, you might want to offset the amount of capital gain, that tax that you pay on a capital gain, by crystallizing capital losses. I know certainly from a personal perspective, I'll be doing this using this strategy this financial year.
So
From a quite a early on share purchase that I undertook many years ago that didn't go quite to plan. So I'll be planning on crystallizing those by selling those to offset a property that I sold this financial year. So just an example of how it can be used.
Yeah.
But as you say, be mindful of the wash sale rule, which means that if you're deliberately selling an asset and then going to purchase it back again, that's considered to be a wash sale, and the ATO is quite aware of those and does not like them, and it is a prohibited transaction. So just don't deliberately go and do that. Yeah.
I guess it's always one of those funny things when I meet people that always claim to do so well in stock markets, and they love talking about their wins, but when they have their losses, they sit there and quietly hide their losses and then claim the losses a few years later on. Pick me, I'm one of those.
Yeah.
Okay, and this is the next one. Again, sounds like making sure you're looking at the timeline. So deferring capital gains.
Look, this is another tip to consider. Again, subject to your broader financial considerations, it might be worthwhile taking advantage of lower personal tax rates that apply from 1 July this year. As I mentioned, the stage 3 tax cuts are legislated, and everybody will get a tax cut from 1 July. And that does mean that the marginal tax rates do reduce from 1 July. So deferring a capital gain by realising it after 1 July this year will just mean that you pay a lower amount of tax. You may pay a lower amount of tax on that gain that you realise when you sell the asset.
Okay. This one confuses a lot of people. So personal services income and a personal services business. So these are sort of like hobby kind of things or side hustles. I think I've heard the term before. What do we need to consider there?
Yeah, look, they are quite complex rules, and I suppose the only thing I'll say there is if these rules apply to you, just make sure that you meet all of the requirements in order to satisfy those. So I won't go into the nitty-gritty of it, but I do recommend that you have a chat to your accountant to make sure that you satisfy the requirements of personal services income.
Yeah, and I guess my daughter runs a small e-business, and I've always very careful with her to say, look, you've got to be careful between what's a hobby that generates income compared to what the tax office will then look at and say, well, actually, that's a business, and you need to be conversant with those kind of rules. So next one, again, is related, non-commercial business losses.
Yeah, look, it's worthwhile thinking about whether these losses apply to quarantine any of your individual business losses. Just be careful of any exclusions that may exempt you from the rules and allow you from using losses in the current income year. And that includes the assessable income tests and a whole range of other tests like profits tests, real property tests, and a whole range of other things. So just make sure, whether these rules apply to you.
And talk to your tax expert at IFPA for
Yeah.
sure. Now, Division 7A we've covered in previous shows, but again, if you do qualify for Division 7A, and those of you that are out there, you'll know who you are. There are certain things to be done there. I won't go into too much detail today because we could do a show on that one just alone. So let's keep moving on. Trust distributions.
Yeah, look, trustees of discretionary trusts and family trusts, they do need to make valid distribution resolutions to effectively distribute trust income to eligible beneficiaries. And those beneficiaries just need to be made aware of their entitlements and their benefit from their distribution. So just make sure that happens, because sometimes we see that it doesn't happen, or it happens a bit too late.
Okay, we're going to move through these last few quickly because we're running out of time. Logbooks.
Look, if you have a business, if you have business use of a private vehicle and want to claim your motor vehicle expenses using the logbook method, then just make sure you keep a logbook. You commence keeping a logbook immediately. Now, although a logbook does need to be kept for 12 weeks, the 12 weeks may overlap between 2 years, provided it includes part of a year. And just also make sure you keep a record of your odometer reading as well.
Okay. Private health insurance.
Yeah, important one. Just make sure you have adequate cover for all of your family members to avoid paying the Medicare levy surcharge, particularly when there has been a change in family circumstances. And that could be, having a new baby, separation, or whether your adult children have aged and, now off your policy. So just a couple of things to think about, because you really don't want to pay more tax than what you're supposed to.
Natasha Panagis from IFPA. Look, we've just about out of time. We've covered off a tremendous amount of material. Some we've talked in detail. Others will be able to point people to website. And again, please talk to your tax agent, talk to your IFPA professional, obviously. And Natasha Panagis, until next time, thanks for being on Dollars and Making Sense.
Thanks, Ray. Thanks for having me on the show.